Alrighty, sports fans, Theta Trader here. Today I wanted to talk a little bit about the differences and similarities between the stock world, the options market, and sports betting world. Three concepts I wanted to get across. First thing is positive expected value, big part of odds jams strategy there. Second is wisdom of the crowd and betting lines as an indication of market value. And third thing is the difference between being a buyer and a seller in the marketplace. And that's kind of where I want to start today. So one of the things that both sports fans and traders really have to understand is that someone else has to be on the other side, right? And that's how they make their money. In this case, the market maker, who's going to be the bookie, is going to charge you a fee every single time in terms of the VIG, right? It's going to be 1, 2, 3, 4, 5%, whatever it is. They are the seller. They are creating the market. And as they create that market, they're charging you premium to participate in that market. The exact same thing happens in the trading world. And this is an example of a trade that I took earlier today on Zillow. I acted as the seller. If this chart doesn't make any sense, just understand that this zero line right here is anything over that is where I make money. The blue line is the expiration date, so in this case it's the end of November, and the pink line is where you can move it every single day to see how much money you're going to make, right? So I started out kind of flat today, and my expectation is that I am going to get paid. I acted as the seller. Someone else is taking the other side of this bet, right? And I am creating the market, so I receive the premium, and the premium is this theta right here. If it's a positive number, then you're the one making that that money every day that it stays inside that range, right? So if this stays between 104 and 84 over the next the next 20 days or so, it'll actually increase in value every day. I'll make 28 bucks, 30, 35, eventually get up to, as we get close to expiration, you make 50, 60, 70 bucks a day on this trade, right? So I am creating that market. I'm getting paid for the market to take that risk, right? If I'm a buyer, I'm the one paying that premium. And as a trader, you want to be collecting as much money as possible for really low risk stuff. So when we think of in the trading world, we think of something that's, and this is actually another stock that I wanted to talk about from today. So the average true range of something over a 14-day period. This is a great concept in trading. So today, crowd went up, the volume just kept going and going and going, right? And you have a positive, an expected range over the last 14 days of about $9, right? For Zillow, it's like $3, which is why I'm comfortable taking that and being the seller on that, because it's not a huge range, right? It's something that's fairly sustainable. It's not going to make a huge move, hopefully, before earnings. But in crowd, you have, again, a positive expected move. You have high volume, and you can actually see it in the options chain. This is an example on Zillow, but you can see where the wisdom of the crowd comes in here. You see there's on the call side, right? You see a lot of volume, right? You see close to the money, a lot of volume. So people are saying, okay, I think this is going to move up. Not a lot of volume on the put side. So today, Zillow popped up as well, and you can see the market participants are they're buying into that demand, right? Same thing in the sportsbook world, right? Where you see, and it's in the odds. It's in like there's a game right here. Colombia obviously 1.71 versus Ecuador 525. But most of the people think that Colombia is going to win this game. Argentina 123 versus Peru 14. The wisdom of the crowd is, think of that as the volume on demand in the trading world. So when you see this, especially in the options side of things, excuse me, when you see heavy buying on the call side, right, and almost nothing happening on the put side, you have a pretty good, it's pretty reasonable to assume that the stock is going to keep going up for the rest of the day. If for no other reason, and these guys don't want to lose their shirts, and they're going to defend that position. And that, again, so that's just that selling into demand sort of a thing. The last thing I want to talk about is the implied probability versus the actual probability. This is something that we look for in the sports betting world. And you can take a look here. I think it's Bolivia versus Paraguay, right? I live in Oregon. Oregon has some of the worst odds. I mean, from the sportsbook side, great odds for me. But if you look at like Bovada, same thing. Paraguay here is priced at 310. Paraguay here, oh well, a minute ago, that's funny. A minute ago it was priced at 330. Let's see if the draw is any better. So yeah, so 315 on the draw, and so 330 here. So I like betting on in Oregon actually because these guys haven't figured out, and hopefully they're not watching, but they haven't figured out how to price stuff correctly yet. It's kind of nice. So, but you want to take a look at the what the street is doing and who has the worst pricing, right? Same thing in trading. So you want to look for that positive expected move up. So if you expect it to move up, $10 like crowd did today, right? First thing you do in the marketplace, you say, well, here it's at $1.50, and I think it's going to go up to going to move up into that 265 strike range, right? And you can actually see here this, the actual candlesticks are what people paid, they bought and sold for, versus what the actual marketplace here says, the implied volatility, the implied probability as well. That purple line right there. So it keeps staying above it, right? All the way into demand, and then it kind of poops out right here around the 550 mark, and then moves back up, and then the entire day, what the options market, at least what the math says, the option is worth is always above what people are paying for it. So people can see that demand is just gonna keep rising, right? Same thing in trading, in sportsbook world of trading. You see something that is undervalued, right? And you say, I'm gonna take a look at this. These odds right here, Ecuador at 525. If another sportsbook says, well, I think this is worth $4, but you can get it here for 525, and you think they have a shot, obviously that's something that you want to take a look at. So great concept that the guys at OddsJam do. Take a look at their videos on how to take advantage of that. And we will move on the next video for the history of sports betting and the history of the options market.